Hello everyone. So we are live, I guess. Yeah. Hello everyone. So in this video, we'll basically take a look at Godawari Power and Ispat Ltd. It is a mid-cap company and they're listed in the Indian stock market. It goes by the ticker GPIL in the NSE, right? And this company is primarily engaged in the business of iron ore mining, and then using that mined iron ore, it produces certain finished products like iron ore pellets, sponge iron, steel billets, wire rods, HB wire, ferro alloys, etc., steel, right? And that it sells in the market further. So basically, mining the iron ore, manufacturing steel and certain iron products, and then selling them in the market. That's basically the business model, right? So the company has two captive mines, two captive iron ore mines of its own, with the total 165 million ton of reserves and 35 plus years life. So it's long term. It has proper arrangements regarding iron ores. There's no need to buy iron from outside sources, because that cost adds to the cost of steel manufacturers. So 85% of its iron ore needs are managed captively from its own mines, right? That's the best part about GPIL. So company has two mines, basically Aridongri mine and Boria Tibu mine, right? Now the market cap is currently 16,000 crores, so it's a mid cap company, and the price to earning ratio is about 22, not too high, not too low, moderate, okayish. Price to sales ratio is currently 3, right? So that means the company is sort of, it's not overpriced if we look from pricing angle, right? Price to sales of ratio of 3 is considered good ratio, right? It's not considered very expensive per se. And so these are the pricing measures: price to book value of 3, price to sales of 3, stock PE of 21.9, about 22. So this is just that the stock is not excessively overpriced. Now coming on to the these profitability margins like ROIC, ROC. So if this is the most important thing, return on invested capital. So the company has an ROIC of 21%, right? So 21% ROIC means it's generating quite a good return, right? Essentially, with the purpose of generating a good ROIC is that every business, the aim is to beat the risk-free rate of return. So the risk-free rate of return in India is about 6.5%. Yes, where can we check it? So if we look at the 10-year bond yield of India, here it is. So it is currently 6.509%. Yes, so Indian government's 10-year bond yield is 6.5%. That means if you don't do anything, just take all your money, take all your capital and put it into government bonds, you will earn a risk-free 6.5% backed by the Indian government, right? So this is a risk-free rate of return. So when we do a business like this GPIL is doing a business, right? When you are doing a business, we are essentially taking a risk, right? So when we take a risk, we demand a risk premium. Investors demand a risk premium कि भाई आप हमारा पैसा ले रहे हो, you are taking our capital, putting it into business, you need to give us something better than 6.5%. So 6.5% is the risk-free rate of return, but GPIL is generating 21% return on invested capital. That's quite a good return. Most companies usually, if you see, generate a ROIC of around 10-15%, right? That's all they do. So generating an ROIC above 20%, and that too on a consistent basis, is very bullish signal for the company. It's generally very good sign that the company knows what it's doing. So if ROIC is good, of course ROC and ROE will also be good. 17%, 21%. Dividend yield is kind of low. I mean, understandable, since company does not is investing whatever profit it generates, and it's investing into itself only, right? By doing acquisitions and setting up new power plants, etc. So that's understandable. Dividend yield being low is okay. Then what else do we have? Operating margin. Yeah, operating margin is also very important for any company. So a 21% operating margin, that's a very good number again, right? The one bad thing about GPIL, like one thing which concerns me, is their sales growth for the last 3 years. It is not just flat, it is rather slightly negative, in fact, minus 0.16%. If we take a look at their P&L statement, so we can see that since March 2023, their revenue went down 5%, then 1.3%. So it has gone down significantly in last 3 years. So after FY22, in the last 3 years, revenue has gone down, and for last 2 years it has gone down significantly. That's the point. So that is a big concern, that their top line growth is not coming as such. Yes, margins are good, return on capital is good, everything else is good. The top line growth is not there. That needs to be there to justify its price to earning. If a company doesn't have any top line growth, then over time the price to earning ratio falls, because people give high price PE rating only to companies which have high growth. That's a very important thing for any company. Okay, now let's take a look at the median PE, right? So over 5 year period, the median PE price to earning ratio has been 9, and over 3 year period it is 13.4. So currently it's trading at a PE ratio of 21, around 20, 21.9, around 22. So it's already trading at a premium compared to its median price to earning ratio, right? So there's that. Company is almost debt free. That's a good thing. Company has a good return on equity. Of course, we talked about it. The only cons about the company are that the company has delivered a poor sales growth over past 5 year. Okay, past 3 years में तो minus 0.16% है, but past 5 year में only 10% CAGR of growth है. That's sort of low, and even 10% भी है because of 1 year in which it got a big jump. Yeah, after 2020 and FY21 and FY22, where it made 20% and then 36% jump YOY in their top line. After that, it has been abysmal. And promoter holding has decreased over last 3 years by about 4%. Okay, let's take a look at the shareholding pattern of the company. As you can see, on an yearly basis, promoter holding has decreased by 4% in the past 3 financial years. 67.5 था पहले, now it is 63.5. So 4% it has decreased, in fact. Although institutional holding has gone up, so promoter selling and institutions buying is sort of okay. I mean, anyways, promoter selling a stock is never a good thing, that's for sure. But at least instead of retail, it's the institutions which are buying, so they must know something which we don't. So on that principle, we can say that the company, since the FII shareholding has gone up, DII shareholding has gone up, so I mean they are putting their money into this company, so there must be something good about it, right? Retail shareholding has gone down. If anything, that's a good sign, right? So as of now, things stand at 63.5 promoter holding, FII holding at 6.6%, DII at 2.4%, and public at 27.4%. Consistently, FII shareholding has gone up only in the last 5 years, right? Then ratios we already discussed: cash flow, balance sheet, and P&L. So only major concern I see is that they don't have any significant sales growth for last few financial years. That's what they need to work about, right? And that we can see in their stock price as well. मतलब वो चीज़ हमको जो है, like that is a big concern, because last 5 year में they have compounded sales growth of only 10%, but stock price CAGR has been 62%. All right, so that is a bit of a problem. Currently they are being priced at a premium, है ना? People are already pricing in that they will do good in future. So if they don't do good, then it might see a sharp fall, but if they do good, then you might not see that big of an upside. Of course, if they do something phenomenal, like some expand into some new sector or do an acquisition which turns out very good, then we might see further significant up move. But as things stand, they need to bring in their top line growth. So we have discussed pretty much everything on this page, I can see, right? Let's take a look at the revenue mix. Yeah, so 97% of their revenue comes from India, and rest 3% comes from the rest of the world. They haven't mentioned from where, but I mean that's a very important, that's a very small number anyway, so it's sort of irrelevant. Almost all their revenue comes from India only, And product wise breakup, we can see that iron ore pellets comprise 31% of the revenue. Then we have MS round, HB wire, and all other finished products of iron, right? 99% of their earning, 99% of their operating profit comes from the steel. That is all these products, right? Iron ore mining and then finished products like steel and all. So 99% of their profit comes from this. Only about 1% comes from power generation, as we saw. I mean, they do have a power plant as well, right? Captive iron ore mine manufacturing plant. They also have a power plant. So there is that. Now let's take a look at their intrinsic valuation, right? Let's take a look at their DCF valuation, which I did yesterday. Now, okay, so of course, to understand this, how I did this and all, I would need a separate video, but I'll explain to you what I did basically here in short. So there are three levers, right? First is the revenue growth rate, that is the growth lever. Then there is the profitability lever, that is the operating margin percent. So this is the profitability lever. And then finally there is efficiency of growth lever, which is the aggregate sales upon invested capital ratio, where invested capital is what? Invested capital is the total equity the company has plus total debt it has minus the cash it holds in with itself, right? So debt plus equity minus cash is the invested capital. So sales upon invested capital is the efficiency of growth lever. Ki bhai, for how every penny put into the business, how much does it generate, right? So if the company has, so if sales to capital ratio 1.5 tells me that if the company invests 1 rupees into its capital via debt or via equity or by anything, it generates 1.5 rupees of revenue. For every 1 rupees put into the capital, 1.5 rupees of revenue it generates. That is what the meaning of 1.5 sales to capital ratio basically is. Alright, now so I assumed sort of high growth for the next, not high growth, I assume moderate growth only. So my growth assumptions are such that for the next 5 years CAGR, I'm assuming it comes out to be about 13.5% growth. For the next 10 years the growth comes out to be 11.5%, right? So this is sort of the assumption, as you can see. And since the company has already maintained quite good profitability in the past financial years, for the next 10 years also I'm assuming it will continue to do so, and starting with 17.5% for the next 5 years and thereby dropping down to 15% profitability margin. Sales to capital ratio, again, when I choose a number arbitrarily 1.5. Now how did I come to at this number? So basically I looked at all the other companies in this steel manufacturing industry globally and in Indian space and in US as well. So in India, the sales to capital ratio for this industry is 1.33. For global scenario, if you take a look at all the companies in the world, then it comes out to, then the average sales to capital ratio comes out to be 1.41. And if we take a look at the US companies which are in this steel industry, the sales to capital ratio comes at about 1.86. Okay, so of course there's a wide variation. In India it is 1.33, in US it is 1.86. So I chose a number arbitrarily, that is 1.5, right? Somewhere in middle. This much I expect GPIL to maintain, aggregate sales to capital ratio, essentially. Yes. So with these assumptions and then we have to get a discount rate, right? Weighted average cost of capital, also known as the discount rate, right? So to get a discount rate, we need a risk-free rate. Risk-free rate, as I said, is 6.5% minus the associated default risk due to because 6.5% is the government bond yield, but there's also a default spread, right? Because there's only one real risk-free rate in the world, that is the US 10-year bond yield, right? Every other yield, every other country's bond has some sort of inbuilt risk in it. So we can calculate that risk by the sovereign CDS spread for India, net minus the US CDS. So the difference we get, that is the default spread for India. So that comes out to be about 0.53%, right? And so the actual risk-free rate of our country becomes 6.5 minus this number 0.53, which comes out to be 5.97%. Then the beta of the company, again the beta of the company you can get from online many sites. For I personally use Yahoo Finance, so we can take a look. So if you open Yahoo Finance page of any company, and then the first page itself shows you this beta, 5-year monthly beta. For GPIL it is 0.73, so I put it in here 0.73. The actual formula to calculate beta is something like this, right? I mean 2 by 3 into whatever beta you got plus 1 by 3, so it comes out to 0.82. That's what you can see here. This is the formula. You don't use exactly the beta, which is, you don't exactly use 0.73, you have to adjust it towards 1. So now it is called as adjusted regression beta, which is 0.82. Equity risk premium, again for US stock market, the equity risk premium is 3.73. This I personally like to take from Professor Ashwath Damodaran's website. He is usually the standard reference for such sort of data sets. So he calculates equity risk premium of US stock markets on a monthly basis. So for November month, he calculated it to be 3.73%. Now this is the equity risk premium for US market. For Indian market, there is a bit more risk compared to US. So since there is more risk, you will demand a higher risk premium. So that higher risk, how much higher risk premium, that you can again calculate using the default spread of the country and the relative volatility of the stock market, right? So the equity risk premium for India comes out to be this 3.73% US equity risk premium plus the country risk premium for India, which is 0.72%. About how I calculated it, you can see it here. Default spread multiplied by the relative volatility of our stock market compared to the bond market, that gives us the equity risk premium for the India, which is 4.45%. so that you can see here. And so you have the risk-free rate, you have the beta, you have equity risk premium. That way you can calculate the cost of equity using CAPM, capital asset pricing model equation, which is risk-free rate plus beta multiplied by ERP. That gives us what? Cost of equity. So that way you can calculate the cost of equity. Then you have the cost of debt, and that gives you weighted average cost of capital, and that I have used as the discount rate in this whole valuation. Also, if you don't want to go through all this calculations, then you can just directly use a discount rate of your own. Like most commonly people use 10%, 12% as a discount rate, right? So you can do that as well. So these are the cash flows. Now at what rate you want to discount them, that is up to us. So I have used a discount rate of 10% here, and that gives a valuation of 178 rupees per share. On using a discount rate, on using the weighted average cost of capital, that is calculating the discount rate, the share value comes out to be at 171 rupees per share. So that is how I have done it. Also, if you use a higher discount rate, 12%, which is okay if you want to be a bit conservative in your estimation valuation, then the shares and the value comes at about 125 rupees per share. All right. So I calculated it using multiple permutation combination, essentially at 10%, 178, at 12%, 125, and if we take an even riskier estimate, let's say 8% discount rate, then it comes at 333. Of course, this is a bit too much. I think 10% discount rate usually matches the market sentiment, right? That's what I have felt throughout all my valuations, so I prefer 10% discount rate usually. Also, if I use the calculated weighted average cost of capital that I have calculated using all these numbers, the valuation comes out to be 171 per share. So as you can see, the current market price of GPIL is 235. Of course, it's quite high compared to the intrinsic value we got, but that doesn't mean I will go ahead and short the company. That's not the case, because I've been very conservative in all my estimates, but market still prices GPIL at about 234. Everyone have their own perception of risk, have their own risk tolerance, and so people will have different opinions. But as per my model, the price value comes at around about 170 to 180 per share. So this is the case here, right? Now, okay, now let's take a look at the different concerns and the company has. So the one interesting, so if you go through the earnings call of the company, you will find a lot of interesting things. So this is the presentation they have uploaded for the second quarter of FY26, and here they have explained their whole business model at a like at a business at a glance, right? Integrated steel business with backward integration of two captive iron ore mines and captive power generation, iron ore pellets, DRI steel and finished products. Then we have these. Okay, so this is the simplified business model of the company. The company basically mines iron ore from its captive mines, and then from that iron ore it creates pellets, structural steel products, galvanized products, ferro alloys, and then they sell it to the market, right? They are trying to expand into certain new areas like cold rolled coils and battery storage. So cold rolled coils are nothing, they are just another finished iron product, and for that company has established a cold rolling mill plant, right, CRM plant, for which they did undergo capex, significant capex in the last financial year as well. uh, Anyway, so it will be one of the new product that will be added to their portfolio. And coming on to this battery storage, now this is an interesting vertical they are trying to enter. Battery storage, BESS, battery energy storage system. BESS systems are getting India is very lacking in BESS systems per se, and I saw some estimates that we would be needing quite a significant capacity of BESS in the next 5-6 years. Yeah, so the current installed capacity is barely 204 megawatt, right? So that's negligible compared to what India wants to reach, right? So as you can see here, the Indian government aims to reach 74 gigawatt of battery energy storage system capacity by financial year 32. So compared to what we are targeting 74 gigawatt, we are still at only 204 megawatt. So of course we would need a lot of new investment into this BESS space. Many new companies like Ola Electric, Amara Raja, Amaron, Exide Industries, even Reliance Industries and Adani Enterprises are entering this space. So GPIL would have a lot of competition in this. GPIL is planning per se of about 10 gigawatt BESS storage system, right? So out of the 74 gigawatt target of the government, 10 gigawatt GPIL is targeting. As you can see here, they haven't mentioned the the total capacity 10 gigawatt, right? So BESS project which they have undertaken, 10 gigawatt target, capex of 700 crores. So will be 100% subsidiary of the company, right? And okay, so this is the FY26 guidance status check. So 3 million ton of iron ore mining, 3 million ton of iron ore pellets, sponge iron, steel billets. Okay, so here basically the graph showing the market price of the iron ore and the price of the captive ore cost, right? So basically the company has this arbitrage where, since they own the iron ore mines, they get iron ore at much cheaper price, right? And then they process it and sell it further. So compared to those players which buy iron ore from the market instead of mining their own, they buy it at this much price, while for GPIL the price is significantly lower, right? That's their competitive edge. That's the moat which they are showing here. And that is this, the financial statements. We already saw them. So yeah, that's pretty much it. And now coming to the conclusion, I'm currently holding a small quantity of this company, right? A small number of stocks, and I'm invested since, like, price of when it was at about this was at around like this period, 180, 190, right? I invested at this point. I'm still currently holding on to, and I still plan to hold only the stocks. But I think the current dip, it actually went on to about 280 per share, 276 per share, but currently it has a significant dip. It is trading at 235. I don't know whether it will go further, it will dip further here or go up. But what I think, it will still go up, right? Because the current expansion into BESS systems and all, it will create a good buzz around the company, right? So it will bring on a whole new wave of shareholders who will be the first time buyers of Godawari Power. So I'm expecting the stock price to go up, right? So I'm planning to hold my stocks, and if there is further dip, might even add some more quantity, right? That's what my outlook is on this stock. So yeah, that is it. Thanks for watching.